Welcome back to Alpha Recap, your quick post-market wrap from stockalpha.ai. Markets were closed for the Independence Day observed holiday, so our last trading reference point was Thursday, July 2nd. As always, if you have questions, you can reach us at stockalpha.ai.
Hey, good to be here. So, what really stands out here is that the holiday tape still gave us a lot to chew on. Three themes jumped out: Exxon's company-level resilience, Ford's quality push, and some wild volatility in tiny, low-liquidity names and leveraged products.
Right. And the other thing is the way analysts are shifting from macro to execution stories. That showed up in a few places, but Exxon was the headline example.
Exactly. Analysts flagged an expected earnings per share of about $3.98 for Exxon and argued the stock could outpace the S&P in the second half of 2026 without a sustained oil price rally. They're leaning on operational execution, cash returns, and capital allocation, not a commodity bump.
Wait, really? So they think Exxon can beat the market even if oil doesn't rally? That sounds like a bold call.
Yeah, that tracks. Proponents say disciplined capex, downstream margin moves, buybacks, and dividends can drive outperformance. Skeptics point out energy stocks usually move with the commodity, so absent a rally, this hinges on flawless execution and refining spreads behaving favorably.
Makes sense. I mean, when you step back and look at this, it's a classic case of company-specific alpha versus sector beta. If management actually delivers the cash flow, the market can re-rate the name even while oil is quiet.
Totally. And that idea, company execution versus macro dependence, showed up in autos too. Ford announced what analysts called a quality milestone, and the CEO pushed for flawless vehicle launches. The logic? Fewer recalls, lower warranty reserves, more stable margins.
Short and simple. Fewer recalls, less one-off pain. Big move for an automaker juggling electric vehicle investment and software builds. If they really cut recall risk, that's a meaningful change to earnings volatility.
Right. And then in the industrials, there's this interesting re-rating narrative around Caterpillar. A Trefis piece argued a growing part of the rally is driven by demand for data center power systems rather than just construction equipment.
That's a big shift in narrative, from cyclical construction exposure to higher margin, less cyclical power equipment for data centers. If true, it could change how investors value the company. But analysts cautioned model outputs can produce extreme ratios, and you should interpret those carefully.
Yeah, exactly. Some of the published model outputs were, quote, extreme, roughly 200% in certain metrics, which screams model sensitivity. So it's an interesting thesis, but it needs real revenue mix confirmation over a few quarters.
Okay, now for the part that probably makes most listeners raise an eyebrow: volatility and liquidity events. We saw a penny stock, LIMN, jump about 24% to around 14 cents on roughly 511 million shares. And SOXS, the leveraged inverse semiconductor ETF, rose about 17% to $4.52 on about 918 million shares.
That was wild. These are textbook momentum and liquidity flows. LIMN's move screams low float, retail attention, or a squeeze. And SOXS is a leveraged inverse product. It rebalances daily and can spike on concentrated positioning or sharp moves in the semiconductor index.
Important to note, leveraged ETFs are not long-term hedges. Their daily rebalancing creates path risk and decay if you hold them for periods longer than intended.
Short reaction.
Big move.
Not what anyone expected.
Let's zoom out to market internals. There was divergence. Dow futures softened heading into the holiday, yet pockets of large-cap tech held up. Apple finished the day up about 4.8%. Meanwhile, Netflix pulled back to about $77.63, roughly a 15% six-month decline versus the S&P's about 8% gain.
So it's a classic leadership split. Some tech names still had momentum, while growth skeptics are pointing at streaming and AI-exposed names that dipped. Analysts are debating whether Netflix's pullback is a valuation buying moment or a sign of slowing momentum.
I mean, when you step back and look at this, these divergences create both opportunity and confusion. A stock can decouple from its sector if company execution is the focus, but that increases the importance of management credibility.
Totally. And that ties into governance and political noise we saw. There were disclosures about members of Congress owning SpaceX stock after its IPO, which raises perception and potential conflict of interest questions. Some say it improves insider alignment. Others worry about regulatory scrutiny.
Quick sidebar. Governance risk can be a catalyst in itself. It's not just earnings or macro. It can change sentiment quickly.
Right. Okay, short segment. Who's affected and how? Long-term, income-oriented investors should care about Exxon's dividend sustainability and Ford's potential to reduce recall-driven hits. Growth investors are watching re-rating stories in industrials and the tech divergence. Traders are being reminded that leveraged and tiny names can whip around. Position sizing and stop discipline matter. Institutional investors should note market structure shifts, like Intercontinental Exchange moving into predictive markets, and the SpaceX disclosures for governance checks.
Analyst language here is useful. We can say, analysts note, or data suggests, rather than making recommendations. This is informational, not personal advice.
Point taken. Let's unpack SOXS and LIMN mechanics in plain English. SOXS is built to give amplified short exposure to semiconductor equities. A move of about 17% in SOXS usually reflects either a sharp intraday drop in semiconductor names or concentrated liquidations and repositioning by traders.
And for LIMN, jumps like about 24% are often liquidity-driven and not a signal of fundamental change. For penny names, retail flows or news spikes can push price sharply, but they often reverse when the volume dies down.
Short reaction.
Wild stuff.
Yep.
Now, conflicting views. The tape framed a few. For Exxon, some analysts believe capital returns and operational gains can outpace the S&P in the second half of 2026 without higher oil. Others say energy historically follows the commodity, so upside without oil depends on near-perfect execution.
For Netflix, some say the pullback makes the valuation attractive after about a 15% drop over 6 months. Others highlight softening quarterly signals and weaker momentum indicators, cautionary flags for growth investors.
And Caterpillar. Traphus suggests a re-rating driven by data center power systems. The counter here is that legacy cyclicality in construction and mining still matters. Small shifts in macro capex could flip sentiment fast.
Which brings us to what to watch next. Analysts highlighted several catalysts: upcoming earnings and guidance, especially second quarter reports and forward guidance from energy, industrials, and consumer names. Volume and open interest trends in leveraged ETFs and small caps to see if spikes are durable. Any further disclosures about SpaceX ownership and if regulators weigh in. And macro headlines that could restore sector correlations, like commodity shocks or policy surprises.
Strategic considerations. Purely informational. Re-examine position sizes when narratives shift from macro to company-specific. Execution risk goes up. For leveraged or low liquidity instruments, quantify path risk and calibrate holding horizons. Monitor warranty and recall metrics for automakers, and watch margin signals in industrials for any real evidence of a revenue mix shift.
And for governance watchers, keep an eye on congressional stock ownership disclosures and any policy responses that could affect federal contractors or related suppliers.
Quick reactions, short takes.
Company execution matters more.
Liquidity moves beat fundamentals. Sometimes.
Stay disciplined.
Before we wrap, a quick investment disclaimer. This episode is informational and synthesizes multiple alpha-breaking analyses published July 3rd, 2026. This is not personalized investment advice and not a recommendation to buy, sell, or hold any security. Analysts note facts and interpretations so listeners can form their own views. Individual circumstances vary, and you should consult a licensed advisor for tailored guidance.
Final takeaways. 1. The holiday tape showed cross-sectional divergence. Company execution stories like Exxon and Ford are getting more attention. 2. Re-rating narratives in industrials are interesting but need earnings-level confirmation. 3. Small cap and leveraged products can move violently. Those are trading stories, not fundamentals confirmation. And 4. Governance and market structure shifts are increasingly part of the catalyst mix.
So, to sum up, the next few sessions should reveal whether these themes are durable or just episodic noise. Watch earnings, volume trends, and follow-through on execution metrics.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Okay, that's it for this Alpha Recap. See you next time, and enjoy the holiday weekend.